Well, thank you very much, Greg. It's a real privilege to be here. Bonjour tout le monde. It really is a pleasure, and what a wonderful room to hold this event in. Quick shout out to all my old professors, especially special shout out to Craig. I see Craig Riddell down there. Craig taught me my first principles course at Queen's when he was a grad student in 1974. So there you go. But anyway, we've come a long way since then, haven't we? So, Doug Purvis, he was a friend of mine. I did my undergraduate degree, as you just heard, at Queen's from 74 to 78. And during my fourth year, I was lucky enough to be invited to take Doug's graduate macro course. So it's kind of hard to believe, but when I think back then, but Doug was only 30 at the time. He was only 6 years older than me, and already had very serious stature. And for some reason, he took an interest in me, in my thesis, my undergraduate thesis, and my plans for grad school. And we stayed in touch after I started work at the Bank of Canada in '81. So needless to say, I admired him greatly, and I was crushed when he passed away in '93. So it truly is an honor for me to be asked to deliver the Doug Purvis Memorial Lecture. And it's a unique opportunity to pay homage to someone special and hopefully to offer you a new insight at the same time. So as I began to think about what I might discuss today, I found myself remembering an important talk that Doug gave at the CEA meetings in Montreal in 1985. So that's the Harold Innis lecture that year. So I was in the audience that day. The lecture was entitled Public Sector Deficits, International Capital Movements, and the Domestic Economy. The medium term is the message. So Doug certainly held that fiscal policy was an effective tool for economic stabilization, but he drew us to a very important caveat in that paper. Stimulative fiscal policy meant government borrowing, of course, and the accumulation of debt through that channel would one day, in the medium term, have important side effects not captured in most macroeconomic models at that time. As Doug showed, these cumulative debt dynamics would, in time, have both domestic and international consequences. Now, many of you will recognize Doug's subtitle from 1985, The Medium Term is the Message, as a reference to the familiar quote, the medium is the message. Well, that was penned back in 1964 by the Canadian philosopher Marshall McLuhan, who I think may have been the most famous student of Harold Innis. So this was very typical of Doug, always clever with words, but in a way that connected with a very broad audience, as others have said. So my hope today is to do something similar in Doug's memory, leveraging his work and, of course, that of many others who followed after. So back in 1985, what Doug did was to walk us through a series of theoretical models, mostly extensions of the Mundell-Fleming model with debt stock effects captured. And today what I want to do is explore the same issues, but using a state-of-the-art policy model to simulate instructive counterfactuals during key episodes of Canadian economic history. Now, of course, I now find myself actually in the job I was dreaming of while sitting in Doug's macro class 38 years ago. And I'm quite sure Doug would never have forecast that. In fact, I think he was rather hoping I would land in academia, believe it or not. But as a central banker, it would be unusual for me to give a lecture on fiscal policy per se. In fact, what I will do is to focus on the implications of alternative mixes of monetary and fiscal policy for public sector and private sector debt, and for financial stability. Now, the concept of monetary fiscal policy mix itself is not all that precise. Now, for one thing, measuring a shift in policy stance requires a definition of what is neutral, which is particularly hard to do in the case of monetary policy. Further, while the change in nominal interest rates probably is the most reasonable proxy for the change in the stance of monetary policy, as would be the change in the fiscal balance for fiscal policy. Both variables are highly endogenous to the rest of the economy. So, for example, a government may set out a balanced fiscal policy ex ante, but because of unexpected weakness in the economy, the fiscal balance turns negative. Now, this would be interpreted ex post as an expansionary fiscal policy, when this was never the intention. And in this sense, the mix of monetary and fiscal policy ex post is only partly a matter of plan or prior choice. So I'm using the term policy mix throughout this piece, knowing that it's not truly a control variable. Although it is possible for monetary and fiscal authorities to exercise some degree of policy mix coordination ex ante, even if all they do is make it clear what each intends to do. Meanwhile, financial stability issues have become top of mind since the global financial crisis, because persistently low interest rates have been blamed for various financial imbalances, including rising household debt, hot housing markets. Indeed, the experience is spawning a new literature on how best to incorporate financial stability risks into monetary policy decision-making. Now, I'll argue and illustrate with concrete examples that the issues of financial stability and monetary fiscal policy mix are intimately related. I'll remind you of some of our important policy history, and then I'll bring us to the present day, where I think the issues that Doug loved to debate remain highly relevant. So to fix ideas, it's worth spending just a few moments describing the policy setting in which Doug found himself in the mid-1980s. Now, for many of you, that's really, really long time ago. You may not have been born. But in fact, I think it's even better to start the narrative a bit earlier. So when I was Doug's student in 1977, inflation was perceived as the paramount macroeconomic problem, since it was fluctuating between 8 and 12%. The Bank of Canada had deployed targets for the growth of the money supply as a means of reducing inflation over time. Experiments with wage and price controls had not delivered. By 1980, breaking the inflation trend would take hikes in interest rates to around 20%. First by then U.S. Fed Chairman Paul Volcker, and followed by then Bank of Canada Governor Gerald Bowie. Now, after a severe recession in 81-82, inflation fell to the 4 to 5% range, and it remained there for the next decade or so. Real interest rates stayed elevated, though, throughout the 1980 to 1995 period. So given this array of developments, fiscal deficits ballooned in the run-up to Doug's 1985 Innis lecture. Now, the 1970s had seen persistent fiscal deficits in the order of 2 to 5% of GDP. But the deficit during the 1981 to 82 recession grew substantially, and it kept widening even as the recovery gained traction. And it hit 8% of GDP in 1984. So Doug's message then was that the implications of those deficits for debt accumulation would someday matter. So as it happens, deficits began to shrink in 1985. But it would take a full 10 years for budget balance to be achieved. And as a consequence, the stock of fiscal debt continued to build throughout that period. The macro situation was made even more difficult by a significant decline in Canada's terms of trade during 1984 to 87. This was mainly the result of a drop in global oil prices, and this made the process of fiscal consolidation doubly challenging. Now, as the fiscal debt ratio rose through the 1980s and early 90s, consternation in global financial markets also grew. In 1994-95, federal debt as a share of GDP reached a peak of 67%. Now today, such a government debt ratio sounds high, but certainly not catastrophic. Importantly, though, real interest rates were much higher in the mid-90s, making the relative debt burden, the burden of servicing that debt, much greater than it is at today's interest rates. In any case, markets came to look negatively on Canadian sovereign debt. They even described the weakening Canadian dollar as the Northern Peso in early 1995. Both monetary and fiscal policymakers responded to this souring of investor sentiment with renewed urgency. Now, the Bank of Canada had committed to inflation targets in 91. Interest rates had actually been on a declining path as inflation gradually went down. But during 1994-95, interest rates were raised again, despite a slow economy, and that time was also caused by weak oil prices. Now, to some extent, interest rates were rising because markets perceived that the associated exchange rate depreciation would loop back into inflation pressures, and this would force the bank to tighten policy again. Well, with the benefit of hindsight, it's likely that this market dynamic reflected the fact that domestic inflation expectations had not yet become anchored by the bank's new inflationary policy, the inflation targeting policy. And that, in turn, made it very hard for the bank to keep one-time relative price effects on inflation distinct from the underlying trend in inflation. Now, this is in sharp contrast to our most recent experience, where well-anchored inflation expectations have enabled the bank to look through the temporary increase in inflation caused by a weaker currency. Indeed, we actually cut interest rates last year to cushion the blow to the economy from falling oil prices. Well, back to the 1990s, fiscal policy was tightened sufficiently during that period to, in fact, get us up to a surplus. And fiscal debt as a share of GDP began a long decline that would be interrupted only by the global financial crisis and the ensuing global recession. So as a consequence, federal government debt as a share of GDP is around half what it was at its peak in the mid-1990s. Accordingly, and at the risk of oversimplification, we can characterize the history of Canada's monetary fiscal policy mix as such. When Doug was preparing his Innis lecture, we had tight monetary policy, easy fiscal policy. And over the following 10 years, fiscal policy gradually tightened. And monetary policy took that trend into account while pursuing its inflation targets. Then from the late 90s until the global financial crisis, fiscal surpluses were generally the norm. Monetary policy remained focused on keeping inflation close to target. In the aftermath of the global financial crisis, of course, the G20 countries all undertook a coordinated fiscal easing, and many of them eased monetary policy as well. But starting in 2010, with the worst of the effects of the crisis behind us, Canada's fiscal policy gradually moved back into consolidation mode. Even so, the legacy effects of the financial crisis have lingered in many countries. Canada's export recovery has been halting at best. Accordingly, monetary policy has remained very easy in order to keep inflation near its target. So in broad strokes, over 30 years since Doug delivered that lecture, Canada's policy mix moved from tight monetary, easy fiscal, to neutral, and then to easy monetary, tight fiscal. Until, of course, the fiscal adjustments made very recently, just about at the time of writing. So this quick historical sketch raises some obvious questions about the mix of monetary and fiscal policies and their consequences for debt dynamics for both governments and the private sector. Intuitively, a tight monetary, easy fiscal policy mix means a relatively slow accumulation of private sector debt and a relatively rapid accumulation of fiscal debt. And of course, an easy monetary, tight fiscal mix would deliver the opposite dynamic. And either one of these dynamics can give rise to financial stability risks, as we saw with government debt in the mid-90s, and of course, household imbalances over the past few years. So now I want to explore those linkages in greater depth. So in the rest of my talk, what we'll do is use the Bank of Canada's core policy model, it's called TOTEM, and that stands for Terms of Trade Economic Model, to investigate the significance of policy mix for these key macro episodes. TOTEM is a large-scale, multi-sector DSGE model. It reflects the consensus view of the key macro linkages in the Canadian economy. And in particular, TOTEM captures the stock flow dynamics for both government debt and household wealth, and therefore debt, that so preoccupied Doug Purvis. Now, TOTEM represents something like 30 years of research effort, beginning, not coincidentally, at about the same time that Doug began to work on these issues. TOTEM is essentially the grandchild of SAM, our small annual model, which was developed in the mid-80s, And Sam incorporated for the first time fully articulated household and government debt dynamics, endogenous potential output, model consistent, i.e. rational expectations for inflation, and SAM was later made quarterly and elaborated in a number of respects to produce QPM, the quarterly projection model, which was our main model from the mid-90s until the mid-2000s. As its name suggests, Totem is the first model of its kind to have a fully developed commodity sector that captures economic and financial interactions with the terms of trade. Now, this investment in modeling more than paid for itself in 2015, when the bank was able to reach an early understanding of the plunge in global oil prices that took place in late 2014 and early 2015. Now, I have no doubt that Doug would have enjoyed using Totem to explore the issue of the monetary policy, fiscal policy mix in Canada. Now, he preferred to gain his insights from tractable theoretical models, but the literature has progressed with more elaborate models, mainly by going numerical. So now we seek our insights using Totem. Now, the best way to appreciate counterfactual scenarios is to examine charts that compare them to actual history. We've just posted this paper on our website, the Bank of Canada website. All the charts are there for your perusal in the privacy of your own room. And in this setting, I'd rather simply talk about what we've learned. So as I said, Doug expressed considerable concern in 1985 about the medium-term debt implications of fiscal policies in place at that time. Now, although budget deficits began a slow decline around the time of his talk, these efforts really became aggressive after the emergence of international financial market pressures in 94 or 95. So in our first counterfactual, what we ask is, what would be the implications for the economy had Doug's warning been heeded immediately, with the federal deficit brought into balance over the 5 years, from 1985 to 1990, about 5 years faster than what actually occurred. And in this simulation, monetary policy is modeled using a reaction function that aims to keep inflation and therefore aggregate demand close to their historical paths. Since neither fiscal nor monetary policy is modeled as truly optimal, we're abstracting from the possibility that different policies might have offered a different, potentially superior set of macroeconomic outcomes. We also abstract from a key monetary policy issue at that time, which was the lack of a well-defined policy target, as inflation targets were not formally introduced until 91. So the specific shock that we analyze is a series of cuts to government spending beginning in 1985 that brings the federal budget into balance by 1990 and holds it there. Now, given the importance of debt servicing to federal spending at that time, this would have meant a significant primary surplus of around 4 to 5% of GDP. Now, obviously, since we're basing our counterfactuals on actual history, starting points matter a lot to our simulations. Now, according to our model, under this assumption of aggressive fiscal consolidation, federal debt would have peaked at about 50% of GDP in 1986-89, somewhere in there, instead of around 67% in 95. Indeed, the federal debt would have declined over the next several years, falling into the high 30s as a percentage of GDP, something like 30 percentage points lower than what actually occurred. Now, under this tighter fiscal scenario, interest rates would be lower by 1 or 2 percentage points, depending on the period, as monetary policy would be cushioning the economy from the downside shock of lower fiscal spending. This lower interest rate profile would have meant a much lower profile for the Canadian dollar as well. The currency would have peaked at around 80 cents US, measured in annual average terms, which compares to the actual peak of more than 87 cents on average in 1991. Canadian households would have responded to this lower interest rate environment by purchasing more durable goods, houses, and therefore borrowing more. And household debt would have been higher by 1995 by more than 3% of GDP. So clearly, with less government demand, there would have been more private sector activity, including consumption spending, housing construction, and, given the lower Canadian dollar, more exports. But what this counterfactual shows is that a shift in policy mix along the lines that Doug was suggesting in 1985 would have had predictable implications for the Canadian economy, but the lower trajectory of government debt would have had a mirror image, albeit more modest in scope, in household debt. So even with this modest experiment, it's clear that the stocks of fiscal debt, household debt, are interrelated. And as for whether one policy mix is more desirable than another, hindsight is always 20/20, and such a discussion would have little meaning here. The Canadian economy was going through a very challenging period at the time, recovering from the trauma of very high interest rates, falling oil prices, and unanchored inflation expectations. And monetary policy and fiscal policy were both trying to achieve very important objectives. So here and in the other scenarios I discussed, I'll refrain from evaluating the pros and cons of these alternative policy mixes. So having looked at what I think is an interesting but fairly arbitrary counterfactual adjustment to fiscal policy in the late 80s, I want to turn now to a more rigorous experiment around the policy mix, starting with a look at the period from 2000 to 2015. Now, in order to focus, good, it's about 35 degrees up here, huh? Give or take. In order to focus only on the question of monetary fiscal policy mix, what we do is to force the fiscal balance to zero and hold it there, and let monetary policy adjust to give us the same output path in the model as before. And that way we can see how the model adjusts only to a shift in policy mix. We use the primary structural fiscal balance as our reference measure of fiscal stance. Obviously, the structural fiscal balance is the actual fiscal balance adjusted for economic cycle and terms of trade shocks. And using the primary fiscal balance simply excludes government interest payments. And what this does is to narrow the analysis to a variable that is as close to pure fiscal policy as possible. So starting with our estimate of the primary structural fiscal balance, we then add fiscal spending shocks to the model to force that definition of balance to zero. And at the same time, we constrain real GDP to follow its original historical path by a corresponding adjustment to the path of short-term interest rates. Now, because the government ran persistent fiscal surpluses in the years before the global financial crisis, this counterfactual would have implied considerably easier fiscal policy during 2000 to 2007, with additional government spending on the order of 3 to 4% of GDP in most years. Federal debt would have risen steadily throughout the 2000 to 15 period, including a sharp rise during the Great Recession. By 2015, federal debt would have been around 70% of GDP and still rising, a higher level than the one that prompted market angst back in the 1990s. Now, clearly, this counterfactual simulation could have tested the limits of policy mix flexibility. Indeed, such a policy might even have proven technically unsustainable given the starting point. But monetary policy would have been much tighter under this easy fiscal policy profile, because the central bank will be working to achieve the same path for real GDP as actually occurred. In other words, monetary policy would be working to offset the fiscal stimulus. Short-term interest rates would have fluctuated between 5 and 10% during most of that period under this assumption, except right after the financial crisis, when interest rates would have fallen to about 2%. But rates still would have risen after that to around 7% again by 2012 to 2015, a much different scenario than the one we lived through. And not surprisingly, the Canadian dollar would have been much stronger under this scenario. Already being pushed toward parity by the steady rise in oil prices and other commodities during 2002 to 2012, the dollar would have averaged about 6 cents higher than its actual historical level, but would have averaged around 10 cents higher during 2012 to 15. This would have meant even more long-term damage to the export sector and an even more laborious recovery from the global financial crisis. So clearly, this alternative scenario strains credibility in various ways, but our objective is not to derive a preferable policy path, but rather to consider the implications of the shift in policy mix for debt and financial stability. Now, the federal government would have been racking up an historically high stock of debt under our fiscal assumption in this counterfactual, but Canadian households would be doing exactly the opposite. By 2015, household debt as a share of GDP would have been more than 20 percentage points lower than it is today, while government debt would be nearly 40 percentage points higher than it is today. Now, there's not a one-to-one inverse relationship between these debt stocks, but that reflects the empirical finding that household debt is only modestly affected by monetary policy, and that, of course, is a characteristic of our model. It also reflects the overall impact of monetary policy on real GDP, which extends well beyond its influence on household borrowing. So the trade-off between the two debt stocks is highly dependent on the array of shocks hitting the economy at a point in time. So, our third counterfactual. It looks at the post-crisis period, very recent period. My goodness, I have air conditioning. Isn't that nice? This is turning out to be a really hot talk. After a significant easing of both monetary and fiscal policies from 2008 to 2010 across most of the G20, there was a pretty synchronized return toward neutral or tighter fiscal policy in the next couple of years. Monetary policy remained easy in many countries, particularly advanced economies. In some cases, was even eased further as recoveries faltered. So this has given rise to a debate around the monetary fiscal mix in the current setting, essentially asking what would have happened had fiscal policy remained easier for longer. And in particular, the issue of rising household imbalances and the associated risks to financial stability have come to the fore. Accordingly, we used Totem to conduct a simulation with the primary structural fiscal balance constrained to zero starting in 2011. Because Canada's primary structural fiscal balance actually moved into surplus in 2011 and rose to about 2% of GDP by 2015, this counterfactual would have entailed rising fiscal spending and persistent fiscal deficits throughout 2011 to 2015. By 2015, federal debt would have risen by about 6% of GDP to around 37%. So, to achieve the same level of real output, monetary policy would have been somewhat tighter. Interest rates would have fluctuated around 2 or 3% instead of around 1%, as actually occurred. The Canadian dollar would have been stronger, of course, as well, by about 3 cents on average. Now, it would be fair to argue that in the context of a soft economy, monetary policy might not have been tightened quite as this scenario imagines, especially since for most of 2012 and 13, core inflation was around 1%, well below the target. But by forcing our model to replicate the historical GDP performance, we forced monetary policy to do this offsetting. That's an unlikely outcome given that situation, but we're not trying to reinvent history, just to learn from it. With the higher profile for interest rates in our counterfactual, household debt would have been lower than it actually was in 2015 by about 7% of disposable income or 5% of GDP. Note that the trade-off between private sector debt and fiscal debt in this shorter simulation is closer to 1-to-1. But even if the financial vulnerability associated with household debt had been lower throughout, it would still have begun to rise again beginning in 2014. So although the counterfactual shift in policy mix would have mitigated financial stability risks, they would still have figured prominently in monetary policy deliberations by 2015. So these counterfactual simulations offer what I call a practitioner's glimpse into a difficult problem. That is, how do we define a guide for monetary fiscal policy mix that, if not optimal ex ante, at least works reasonably well on average ex post? Now, literature on this subject has employed increasingly complex models, but they still remain far more simple than the sort of model we're dealing with here today. So one can only learn so much from the conclusions that have been reached to date. But a key finding in that literature relates to monetary policy's commitment, or in common parlance, inflation targets. In a model with government debt, the higher the level of that debt, the more incentive there is for government to create some surprise inflation. Because, of course, surprise inflation will erode the real value of outstanding debt and reduce the need for future taxation. So such inflation surprises erode the value of private sector savings, and in time they lead to a de-anchoring of inflation expectations. So clearly an inflation target committed to by the central bank, and in the case of Canada, agreed to jointly with the federal government, can help offset that incentive. Accordingly, models with inflation commitments tend to predict a lower stock of government debt. And the credible inflation commitment gives both monetary and fiscal policy the ability to offset more macroeconomic fluctuations. But because inflation stability emerges only when the economy is sustainably at full capacity, the coordination problem between monetary and fiscal policy is highly simplified when there is such a joint commitment to inflation targets. Where the issue of monetary and fiscal policy mix comes to the fore is when the economy is far from equilibrium and persistently so. So as we saw in the simulation, starting points matter, and they matter a lot. Persistent disequilibrium gives rise to accumulating stocks in either the public sector, or the private sector, or both. And as is well known, so-called Ricardian effects are likely to become increasingly apparent as private sector debt rises, because of course households know full well that they'll have to pay someday, so they'll not accumulate debt ad infinitum. But there's every reason to expect similar reactions to high and rising public sector debt. So, this suggests that there is a meaningful trade-off in the policy space between the medium-term consequences for debt of monetary and fiscal policies. An easy monetary, tight fiscal policy mix will lead to higher private sector debt, lower public sector debt. Similarly, a tight monetary, easy fiscal policy mix will lead to lower private sector debt and higher public sector debt. In effect, for a given macroeconomic situation, policymakers have the ability to choose the dynamics of those two debt stocks. They can't influence the two debt stocks independently, but their policy choices have simultaneous implications for both. And what we lack at this time is a coherent framework for weighing the relative macroeconomic consequences of private sector versus public sector debt. For a given economic situation, what combination of public sector debt and private sector debt represents the best outcome? Well, on all counts, this trade-off is likely to be extremely complex, highly dependent on the economic situation, and therefore likely to complicate significantly the choice of policy mix. The next generation of policy models will hopefully be enriched in this dimension, capturing the complexity of the underlying linkages between economic behavior and financial variables in much the same way that Totem made such a significant advance with respect to terms of trade shocks. No doubt over the next few years we'll learn much more about this trade-off at a practical level. So let me conclude. We've seen a lot in the 30 years since Doug Purvis gave his Innis lecture. We've learned that there are limits to how much government debt financial markets will tolerate, as Doug thoughtfully predicted. We've also learned that in unusual circumstances, private sector debt can reach levels that can similarly strain the tolerance of financial markets. These strains inevitably feed back into monetary policy deliberations, either because they have real effects on the economy or because central banks see the danger of making financial stability risks worse while trying to lessen macroeconomic risks. Central banks are actively engaged in determining how best to incorporate such financial stability concerns into the conduct of monetary policy. The analysis here has shown that there is an intimate connection between the debt stocks embedded in financial stability issues and the monetary fiscal policy mix. Monetary policy objectives, such as monetary or inflation targets, have historically been seen mainly as a way of staying out of trouble. They're meant to manage macroeconomic risks in the face of uncertainty while delivering a less uncertain environment for economic decision-making. And while experience shows that inflation targets have improved macroeconomic performance, the experience of the global financial crisis and its aftermath demonstrates very well that such targets are not sufficient for preventing trouble. Clearly, there can be medium-term consequences that must be taken into account when formulating monetary policy, certainly in the presence of persistent shocks to the economy. So this strongly suggests that the best mix of monetary and fiscal policy will depend on the economic situation, and any derived optimality condition is likely to serve only as a rough guide. Rather, policy coordination around an agreed goal seems to hold out more promise than seeking an optimality condition. Now, given the sanctity of central bank independence, the narrowest form of monetary and fiscal policy coordination would be for the central bank just to take fiscal policy into account while pursuing its inflation target independently. However, within an institutional arrangement that enshrines central bank independence, there is still scope for ex-ante sharing of information and judgment between the two authorities. And after all, the inflation target in Canada is agreed to by the central bank and the government. And this institutional framework is a simple and yet elegant form of monetary and fiscal policy coordination that actually may have anticipated some recent literature. Now, my guess is that Doug Purvis already understood most of this. Certainly, he pointed us in the right direction 30 years ago. So, if I may paraphrase one of my late friend's most famous lines, the appropriate monetary fiscal policy mix depends on the situation, but the medium term is still the message. Thank you very much.
You're wearing a lapel.
Yes, sir.
Oh, the governor's time.
Yeah, I could talk for you.
The governor's very kindly agreed to answer some questions. So graduate students, assistant professors, other humanoid entities, please go, if I could ask you, to one of the two microphones, and let's take advantage of this opportunity.
I'm a University of Ottawa alumni. Governor Poloz, at last year's CEA meeting, I gave a talk on replacing your bank's dysfunctional CPI, excluding changes in indirect taxes measure, with a constant tax CPI, similar to the European constant tax harmonized index of consumer prices. It's important as this index serves as the frame for most of your core inflation measures, including your operational guide, CPIX. One of your research economists, Louis Morel, attended and asked me to give the same talk before the Bank of Canada. So I want to ask you first, can you give me a date and a time? And second, does the bank intend to reform this series with the renewal of the inflation control agreement later this year? Thank you very much.
Yes, well, the inflation control agreement is up for renewal this year, at the end of this year. So I suspect, like everything in Ottawa, I can predict the date and time. That would be December 31st, around 5 p.m., provided that's still a weekday. Although we might want to knock off a bit early that day. But in any case...
That's not the date I asked you about.
Oh, what date are you asking me for?
Oh, when I can give my talk before the Bank of Canada.
Oh, I see. Well, we're wide open for input on all these topics. I don't know, if you've written it down, we'll definitely read it. I don't know when you can present it, but we are wide open. We received a great deal of input onto the questions that we're considering for this renewal. And much of the research has already been posted on our website. And we're now at the stage where we're having those active discussions between ourselves and the Department of Finance. So it's still a wide open game. So it's just, if you have new thoughts on those, that you just give us the stuff. We'll happily accept it.
Thank you.
Turn here, Chris.
Thank you, Governor. Very nice insight about the trade-off between public and private debt and how that's related to the policy mix.
Thank you.
It wasn't so long ago that we macroeconomists talked about monetary dominance, right? The basic idea that whatever fiscal policy was doing, monetary policy could more or less offset it and keep aggregate demand where it wanted it to be.
Right.
And I'm wondering if today, 8 years after the financial crisis, with very low interest rates, balance sheets that are still being repaired, confidence that's not great, I'm wondering if your views of monetary dominance have changed at all.
Fundamentally, they have not. But we have to accept the fact that by the shocks that we've been hit with, we've been driven to the neighborhood of the lower bound. Somewhere in this neighborhood, there's a lower bound for interest rates. And we're in the vicinity where interest rate actions have smaller effects on the economy than they do in the normal space. And so, in effect, my talk does reflect that evolution of thinking that, as we all know, this is not a new idea. This was written about it during the Depression when you got to the lower bound. And the Great Depression, we realized that actually monetary policy could get a stage where it really is almost not having any effect. And we have new tools nowadays which have a little extra to them compared to what we thought before. We thought interest rates had to stay positive, and now we discover that They don't. About a third of public debt in the world now trades at a negative nominal interest rate. And so that's pushing that ever lower, and that matters to the policy setting that you're setting up for dealing with shocks. But the fact remains that in this neighborhood, we know that fiscal policy is much more powerful. You know, for a piece of stimulus, it can have a direct effect. And so that's exactly why the question of policy mix is a little more alive right now, because so many central banks are feeling the constraint of that lower bound, and that if you have the room to maneuver, some countries, such as Canada, are using a bit more fiscal policy to try and fix that mix up a little bit. So, but I don't think it changes the monetary dominance or independence in that sense, because in the normal course of events, fiscal action is usually either automatic stabilizer or worrying about other things that are under the surface. And I think that does leave appropriately the stabilization around, which is anchored by an inflation target, to the central bank. That is the appropriate way to order things, but of course, within that, fiscal policy has a range of objectives that they try to succeed with, which are independent of where the cycle is. Over here, James.
Yeah, Steve, I was very interested in the public debt versus private debt, but I was a bit surprised you didn't mention another major source of debt, namely provincial debt, which must surely respond to some of these policies that you analyzed.
Absolutely right. It's a significant omission, just a level of detail that we weren't prepared to go into. We're implicitly holding all of that constant in this analysis. But if you took a variable and said, let's have public sector debt in total, let's say, and redid all of this, then you would just define fiscal policy as a neutral line with that bigger aggregate, and all those conclusions would still follow. So we're just holding them constant in this.
I'm sure they would, but I'm not sure that's the right thing to do if you think of the federal government or Bank of Canada as making a policy and provinces sort of then being buffeted by that policy.
Yeah.
It's really not obvious that the whole thing is going to be held neutral.
Yeah, well, again, fiscal policy in general, and certainly at the provincial level, is far less about stabilization than it is about other fiscal objectives. And so, indeed, it's more a case of providing services at a price that's affordable, and you get deficits when if you cyclically adjust those things, the deficits are usually relatively small. So they're not counter-cyclical in that sense. They're pro-cyclical. So in that sense, you're absolutely right to be fulsome about it. We should look at it that way. And there may be, if there were a fiscal action at the federal level, there could be an offsetting fiscal move in a provincial setting, none of which is taken into account in my context. But I think we could certainly probably do that in our heads.
Thank you.
Thanks.
Randall Moore, University of Alberta. I was intrigued by the distinction between public sector and private sector debt accumulation in monetary policy. I worry that in Canada that distinction is less clear than it is in the United States or other countries because of the CMHC. So in Canada, if I take out a mortgage, it's typically backed fully and guaranteed by the federal government. And a lot of our private sector debt is mortgage debt. And in the event of a wave of mortgage bankruptcies in Canada, that debt is transferred onto the federal government's balance sheet immediately. So doesn't that mean that kind of building up private debt is kind of in a shadow sort of way building up the risk, at least, of a major hit to the federal fiscal position? And if so, can that distinction really make sense in Canada?
Yeah. Well, it's a good question. There is a substantial portion of private sector debt which has this insurance attached to it, which is not only CMHC but other private entities as well. But viewed from the point of view of the agent themselves, I don't think they think of it as you know, they're off the hook. It's just because, I mean, to me, they accumulate that debt, they know that's their debt, and so on. So the behavior, I think, is exactly as if the insurance wasn't there. The insurance primarily is there to ensure a good level of financial intermediation. So it's really protecting the financial system from a major hit. So if you had, such as in the United States, a major housing rout, then that would feed back to the banks and put banks in jeopardy, and then there are all sorts of measures taken. If the key linkage is one in which CMHC has already got a big fund that is there to handle that kind of shock, then you have a safety net under the financial system. And when we publish our financial system review, which is actually next Thursday, twice a year we do that, that's really what we're analyzing. We're not analyzing little shocks or little risks. We're analyzing the tail risks. In what situation would there be a significant risk to the financial system as a whole? And that is seen as a pretty key shock absorber in that kind of scenario. And I agree with you that it means that ultimately there's a public sector piece of that, and it's just simply, it's absolutely true. It's arithmetically true. But I think it would only affect people's behavior in extremis. I don't see it as an important linkage for the kinds of scenarios we were conducting here.
Governor, a few years ago, your predecessor spoke to another stylized fact of perhaps the last 30 years, and that was the other private sector balance sheet, not the household sector, but the corporate sector. Mm-hmm. And this wasn't so much about accumulated debt, but perhaps accumulated assets. In this case, referring to the observed growing corporate surplus that we see in the national accounts. So my question is, does the totem model incorporate the corporate sector's growing surplus, and how, if not, is it possible that this may affect the counterfactual simulations that you spoke of today?
Yeah, so what is capturing is wealth for the economy as a whole, so that it's in there. It's not singled out for analysis, what we're doing here. But what really matters there is that, yes, there is, I feel like in the last few years, kind of a mirror image there, accumulated wealth in the corporate sector. And it's been through a period of intense uncertainty, repeated uncertainty, and continuous, or what I call serial disappointment in the outlook. And therefore, about as close as I can imagine to what Keynes was writing about in the 30s, animal spirits, as one can imagine. So crushed animal spirits, and in that setting, it's very often the case you keep your hard-earned money right where it is until you've got a little more daylight in front of you. And so what we're seeing in talking to companies is that they're actually getting very close to feeling confident in the future, and are finding themselves at their capacity limit, and therefore have to decide whether they're confident or not. If the question a year or two ago would have been the same question, but they'd be like, oh, I've got lots of excess capacity, so I don't need to invest with that money, so I'm holding my powder dry. So anecdotally in our surveys, it suggests that the desire to invest is quite strong, and the good news is that the corporate sector in general is well financed, ready to actually do it, and there won't be any credit constraints there, except perhaps in the small sector, where hopefully everything will go well. But that's in the large company sector, there's a lot of capacity to invest. So ready to invest is better than being completely unready, but wanting to, if you know what I mean. So that's where I park that capacity.
But until that moment when they actually invest, there probably is a role for another actor to...
Well, possibly, but the point is that it's all about accumulating evidence of positivity. And in fact, it won't happen like all across the board at the same time. And we can look under the data and see it is happening in several key sectors. But given the decline in investment in the energy sector, you just can't possibly see it in the macro data yet. But we're confident that it is occurring, and it will happen in a cumulative process. And we think that in the second half of this year, we're going to see it more at the macro level.
How do you think the presence of macro-prudential policies, which explicitly try to limit the growth of credit, factor into the trade-off between monetary and fiscal policy?
Right. So that's what I was alluding to near the end when I said, the next generation of models needs to capture all these dynamics, but it's also going to have to capture some other tools, and it'll be those kinds of tools, so that we have a space. Right now we kind of experiment with things with small models to help us understand how a macroprudential tool would work, but it's very hard to do in a big GE situation, okay? And so that's where I'd like to see the research go. So I do think that when we have big and persistent shocks like we've been living with, like this could, this has been going on for 8 years, so it's already big and persistent, and it's evident that monetary policy is still doing a lot of work just to keep the economy from falling into something more negative. And so in that setting, I think that having some additional tools that are designed with that purpose in mind would be a more wider range of tools would be a good thing to have, and it would be the sort of coordinating conversation. We have a coordinating mechanism for that in Canada called SAC, the Special Advisory Committee, which is meets 4 times a year, and the bank is a key advisor in that setting, and so those kinds of macroprudential things could prove to be of continuing importance for a while, and certainly we've made some good moves in the past 5 or 6 years that have probably helped us quite a lot. We can't really imagine the counterfactual, but I believe they have helped us quite a lot. So that's definitely a toolkit worth expanding on and developing further. Russell.
Hello.
How long does this go on? Like until everybody leaves, or? Oh yeah, no, I've got. It's Saturday, for God's sake. I got all kinds of time. But I'm just wondering. Okay, Russell.
Yes, in the distant past when I was studying macro at UBC, little distinction was made between macro theory and growth theory.
Yes.
And there didn't seem to be a great deal of mention of growth in what you're speaking about. It's, as you say, it's there, it's implicit.
Yeah.
But although a lot of growth must, of course, come from the private sector, the conventional wisdom at present is that the key to growth is innovation. And it strikes me that fiscal policy, rather than monetary policy, is best able to help to promote innovation in the economy.
So I think I would agree with that. In fact, I would broaden the thing a little bit, which wasn't discussed here, which is structural policies. Let's just say government policies more generally. So pure fiscal may be able to enhance the capacity for growth, for example, through infrastructure or education spending, that kind of thing. So there is a very strong growth orientation to the things that are listed in the finance minister's to-do list, his mandate letter from the prime minister. So obviously they think just like you said. And but I think what's more important is there's a third leg of the stool that we're not talking about much, and that's what we collectively call structural policies. And what falls into there are things like labor market constraints, interprovincial trade constraints, international trade constraints, all the things that are growth impediments. All right, and so and this is why the IMF, the G20, the G7 have put so much emphasis on that third leg, because we're at the stage where potential growth is slowing right before our eyes because of demographic reasons alone, let alone possibly, if Bob Gordon is right, it's slowing for more of the reasons than that. And so if you take that and say, well, what can we do? Well, there's a lot. It only takes 5 minutes for you to write a list of things worth doing that would undoubtedly raise growth capacity. And in the old days, you might say, well, if the economy was growing at 2 or 2.5 or 3%, oh, here's a policy that would increase it by 0.1 or 0.2, and you'd be like, oh, really? Is it worth all the trouble and heartache and all that? And you say, well, maybe not. And so they don't get done. But I think trend growth rates are slowing down below 2% because of demographic reasons, and possibly, we don't even know what the innovation line will look like. And so in that context, adding 0.1 or 0.2 onto your trend line is a huge difference. And so we should all be standing up as a profession for stuff like that. And, telling me a trade deal will only add this or only add that kind of sounds a little odd in an environment where the base is so potentially low. So I agree with you in general. Those are kind of fiscal things, or government things is probably a better term. And the fiscal policy does have a way. If we go back to the 50s and 60s, the infrastructure that we all grew up on, that was an amazing injection of government spending after the war, because everybody thought we were going to slide back into the Great Depression. And over a percentage point per year of GDP growth came from that source. It was all about highways, bridges, and education. And largely, that base of infrastructure is kind of about where it was. So there's a lot that can be done, and Chris, I'm sure, will tell me how to do it in a green way. Right, Chris? Thank you very much.
So